Okay, so this is part two of the Fibonacci trading system. So in the previous part, we discussed how you can use Fibonacci retracements to sort of aid your take profit goals and just bring a bit more clarification as to what levels you should be aiming for and what levels are realistic in terms of probability. And essentially what we measured was we looked at the point of break in the of the trend line, and we used previous market data to figure out where price could potentially go before reversing, meaning that we encapsulated the bulk of the movement. Um, and so we went over channels, the breakages of channels, of ranges. So for example, like this, if we had a channel like this, we went over if there was a break in this channel, where could we reasonably expect price to go? And that was relatively simple. There isn't too much sort of nuances that you need to be aware of, other than being aware that a lot of the times price can falsely break, and I'm saying false in air quotations because there's nothing really false about it. It's just a natural movement in price in the Forex market. But now that we've sort of went through that, the next part is measured movements on spikes, and this is a typical ABC pattern. So a lot of the times in the market you will see some sort of two-legged structure like this, and we essentially want to figure out from this data here where could price reasonably go once this point is broken, and where is the best point to enter to continue the trend down. So we have here some clarification points. So what actually is a spike? So a spike is just a singular movement in price that is clearly identifiable, clearly being very, very important to consider, because this isn't a spike, this is a spike. You want it to be very, very noticeable, therefore other traders will be noticing it as well, which increases the likelihood of that spike retracing and then continuing that move to the upside. A lot of the times prices can randomly spike and then just simply retrace on the lower probability event. So if there's no sort of really strong technical reason for price to break out, for example, if it's in some sort of consolidation period, if price is just randomly sort of really flat and really choppy and not really doing much, and then all of a sudden it spikes up, then you might consider that to be a lower probability event, especially if there's no sort of fundamental stimulus explaining why that price is moving the way it is. So should price just randomly spike out without any sort of news or any sort of data release or any sort of technical reason, then just expect price to fully retrace as it often does. But don't try and fade that spike, because you don't know the sort of magnitude of the spike and where it could really begin. And then use local patterns in your structure bias to determine direction and be wary of significant pullbacks. So if you aren't aware of how to use your local patterns and your structure bias to figure out where price is most likely to go, don't worry, because there will be subsequent videos explaining how to figure out bias and how to figure out market structure. But as of now, these are the most important points to consider if you are considering trading spikes. Now, your valid spikes are your spikes that exceed your previous range in a very short period of time. And this sort of links in with the idea that spikes need to be easily identifiable. And if you have price that's whipsawing around in this range and then breaks out, then that's clearly identifiable by other traders, and then you could capitalize off the subsequent moves as other traders begin to realize and have the similar thought patterns and similar line of thinking that you might. And another determining factor of whether it's a valid spike is whether it's fundamentally driven. If there's any sort of data that's been released, if there is any sort of some sort of news, that's often a great indicator of a valid spike. So the anatomy of a spike usually occurs like this. So what will happen is there will be a shift in order flow. Okay, so we have normal order flow, which is buyers, which mainly consists of buyers and sellers, but more so sellers driving the price down. But then at this moment there is a shift in order flow where there are significantly more buyers than sellers, and what will tend to occur as the volume really rapidly picks up, algorithms with the pricing models based around catching these spikes will start buying and buying and buying, sort of further pushing up the spike. And as they begin to sell, that's when you have the consolidation period of whatever sort of pattern you want, whether it's ascending, whether it's descending, whether it's a flag sort of type thing, whatever sort of pattern you'll see a lot of them. Now, in that sort of consolidation zone is where most retail traders will be entering, just because this is where their main source of liquidity is. If you're trying to enter in here, they're going to be experiencing quite a lot of slippage, and whether that's if they even get filled at all, and it depends what type of order they're using. If they're getting if they're putting in a market order, the chances are they'll get incredibly bad slippage, so they won't really be doing that. And if they're putting in limits or buys, then they might just not get filled at all. So up until this point, this is where you have your retail begin to enter, and it's at this moment where price usually decides whether it wants to fade or whether it wants to hold some sort of support level and continue the move higher. So I do have a few examples that can be shown, and what we have here is we have a previous really bullish structure, so we would be looking for buys into this because, as always, we want to latch onto that pre-existing trend. It's always better to hop on the trend, even as most experienced traders will agree that the best probability setups are just latching onto that previous trend and not going for the reversals, as a lot of traders tend to do. So we have our bullish structure here, and this is broken here, so we have quite an equal order flow here, which is very slightly bullish. We are setting higher lows and higher highs, at which point it's broken, and then price becomes very unidirectional and very singular, and we see no pullbacks until this point, until here. And this is where the consolidation period begins, and this is where the retail orders begin flowing in, whether it's to the sell side or whether it's to the buy side. So I've marked this point A and point B, and this is where you're dragging your Fibonacci tool to the first point of that shift in order flow, which is here. It's not down here, because at this point we still had pretty choppy price action where there was no real conviction in the order flow. And then here we have that conviction in the order flow, so we measure from this point to this point, and we look for price to regress to the 618 level. Now this is a level that I've found, and it depends what sort of person you ask. A lot of people will sort of buy at this point here, where price is confirmed to break out of the previous high, and that's their confirmation signal. I tend to want to get in a bit earlier, so I have a bit of a better risk to reward, and for me that's just how I do it. I always aim for the 618 level, and I usually set my stop loss at the 382 or halfway between the 0.5. Usually when it's quite a large range like this, I would set it to the in between 0.382 and the 0.5. But when prices when you have a significantly smaller range, then you don't lose too much risk to reward by just sticking it on the 0.382 level. And you can see here that the risk to reward of this is about 4.27, and this one is about 4.50. So the area that we're actually targeting is the 1618 level, as per usual, with TP1 being here. Now on the trendline break, we actually targeted to take profits. Firstly, the 1618, and then the 2 level as our TP2. Now some people go for the 2618 as a sort of 20% of their runners. They target them up here, and that's absolutely fine. A lot of the times it can actually hit, but you have to understand that we are quite overextended in this particular uptrend. And so it is quite a sensible option just going for the 1618 when you are on quite an extended trend. Now, when we see the trend begin to switch, where we set lower highs and lower lows, then we can reasonably expect price to take a shift in the market direction and perhaps to the downside. And this is when you begin targeting the 2618 level, previous market lows here, or previous market highs. For example, here where that shift of order flow begins, and as I said in this point here, we are using the local patterns and the structure bias to determine the sort of odds and the probability of our take profits getting hit. So it's not some sort of one size fits all strategy. It is something that you do have to sort of tinker with, backtest, figure out what works and what doesn't work for each pair. But this is the sort of bare bones of it. A few other examples here. We see that shift in order flow begin about here. So in this one we still have quite long candles on each, quite long wicks rather, on each side, and so I chose this to be the 0 point where this is the first sort of sign of conviction that price is really going to head lower. And then on the first pullback where the consolidation period began, not really consolidation rather, but just the pullback occurred, and then the orders were set in at 0618. I was filled. Price regresses just below the 50% level before heading lower, tagging the 1618 level before performing sort of a mini pullback, and then finally tagging the 2 level by the pip before heading up. Now, of course, price did end up, absolutely tanking, and it did also pretty much retrace this entire uptrend. But at that point, we don't know that that's going to occur, and we just want to. This is a scalping technique. This is the 30-minute time frame, and we aren't in these trades for any longer than a couple of hours at most. And so that's realistically what we want to be hoping for. We want to be in and out of these trades. Here's another example of this occurring. So again, we have our singular direction in price, first pullback, and then we're targeting the 1618 level. And eventually the 2 level is hit by the pip before really pulling back, and you probably would have been stopped out had you been targeting this level here, even though it was hit, but because of this pullback you probably wouldn't have hit the 2618 level. So that's why I tend not to go for this one, and I usually just go for the 1618, which gets tagged in here, and the 2 level, which is tagged in right here. Okay, next example is Euro Aussie dollar. Not actually too sure where it's went. Here it is. So this is actually an example of it not working, and I just wanted to clarify that this isn't some sort of 100% win rate strategy. As with all things, you are going to lose occasionally. That's just the nature of the game. But because this does have a fairly high risk to reward, you don't have to be right all the time. It gives you that the luxury of not having to be right even 50% of the time to make quite convincing profits on this. And so this is me setting up the trade exactly how I would normally. This is on the 5-minute chart, so we will see these little micro pullbacks that we wouldn't normally see on a 30-minute chart. And what we see here is we do see the trade ultimately failing had you measured it at this point. But now I'm actually just looking at price right now, and I see that this has a mini pullback in this zone here. Now, if you were on a higher time frame, then maybe you might have been able to notice that pullback begin to occur. And so if you had been able to measure it to here, you can see that the 1618 level and the 2 level is hit, but price didn't tag in the 618 level. But if I actually just pull it down to the candle body, which I normally do, you can see that the 618 level is hit this time. Have I done that incorrectly? Shift of order flow up into the 1. So the 618 level still isn't hit. So occasionally you'll see a good setup, it'll work, but it just won't hit your take profit. It won't hit your entry trigger, and that's fine. as we said, that we don't have to be right all the time with trading if we have our risk reward that works. Now here we have an example of where it would have worked, and we see that price hits the 618 level, bounces off the 0.5 level before narrowly missing that the 1618 level. So in these examples that I've just showed you here, it can sort of highlight how frustrating trading can actually be, especially with when you're in really successful trades and it's just missing those take profits by a few pips. Let's just measure that just for the shits and giggles, and you see it did miss by about 10 pips. But you do have to realise that we did actually manage to encapsulate a 150 pip move. So perhaps whilst you're doing that trade, you might realise that this is quite an ambitious take profit, and you manage the trade accordingly. Who knows? And then on USD CAD, we have another example of where it didn't actually work. We have our consolidation period here. We have our shift in order flow. We would have been targeting this area here, entering in here. So when price breaks here, right here, stop loss at the 3.2 or in between there. And you can see that price didn't actually go there, and we wouldn't have hit that take profit. So I did think it was just quite important to clarify that this isn't a 100% win rate strategy. Now, if we're measuring from this point, and then we entered here on the 618, right here. So that just tagged us in just by the pip. Stop loss at the 3.2 or in between the 3.2 and the 0.5. And then we are targeting the 1618, which that would have hit, and we target the 2. And would that have hit? It would have hit just by the pip. So in that risk reward was 7.69. So even if you are only hitting this, let's say about 30 to 40% of the time, you're still in a massive margin of profit, because usually the lowest risk reward you'll ever have is about 4. And that's just if you're hitting the 1618 level. If you're hitting the 2 level, then you've nearly doubled your risk reward. So as long as you have good risk reward management, this strategy can be incredibly lucrative. It is really tough to so the best traders I know understand how to trade the fundamentals and the technicals almost in tandem, and you do sort of need to understand the fundamentals behind Forex, and you need to be able to know why these spikes are occurring, at least on a technical level, that we might be seeing a shift in market structure or just a sort of pullback on a more macro time frame. Now, if you don't know these things, then don't worry about it, because there will be more videos sort of explaining this. But I just sort of wanted to throw these together just to give you a bit of an entry on clarifying where you should be aiming to sort of take profits in your entries, and a few strategies that do work to the next level.